You can and you can take your credential off if you want, but you've been credentialized.
Okay, good. You want mine?
If you'd like it. Long time no see. We saw each other just last week. We've been talking. We haven't seen you this morning, but we've been talking with the Treasury Secretary. We saw Lloyd Blankfein and Paul Singer, and we've been talking a lot though this morning about oil and energy and what that's done to the market. You were at our conference last year. You made some bold and correct calls about which way the markets were headed. And one of the things that I keep getting worried about, as I said to Lloyd Blankfein this morning, is right when you think that, when everybody thinks that things are great, they're usually lousy. And so right now it feels like people think it's great, in part because energy prices have come down. What say you?
Well, unfortunately for me, I was in Saudi Arabia yesterday and Kuwait yesterday, and I'm back here today. So I was in the Middle East for the last 4 days. So I have a pretty good handle on energy prices. I probably came away from the Middle East more bearish on energy, more bearish that prices can go down low, more bullish on the world because this is good for the world. But it's fair to say that the oligopoly is confused right now. You know, when you have an oligopoly and you have stable pricing and you can control pricing, life is pretty darn good. And now they control 30% of oil and they can't control it anymore and they're confused. One of the great things I learned was Abu Dhabi actually in the last 6-8 weeks raised production. So not only can they can't control the price now, you know, there's a lot of conversation about should they reduce production. They're actually increasing production. So Abu Dhabi has gone from 2.8 million barrels a day to 3 million barrels a day. Why? They want to make sure their cash flow remains the same. Many people think this is a conspiracy in the Middle East, that they're really trying to attack the United States related to fracking or focus on Russia or Iran. The fact is, the last time Saudi Arabia lowered production in response to lower oil prices, it took them 10 years to get that market share back. And now the fundamental issue that's going on is in the last 2 years, much because of the United States, we've increased global supply by 1.6 million barrels a day. And we've only increased demand 600,000 barrels. So we have this 1 million barrel excess supply. And at $100, we were going to accelerate the mismatch. China historically was growing at 600,000 barrels a year in net new growth. And the last year, I think in July, they came out saying we only need maybe 250,000 barrels more a year. So the trend for demand was decreasing and the trend for supply was increasing. And then you focus on the substitution rate of oil for electric cars, or the introduction of cars like the Ford 150, which increased mileage by 12 miles. Right. And then you create substitution for trucks into natural gas. You know, we're now at a period of time where there is price, the best way to put it, realization. We're trying to come up with a true market sense. The last time we did this was right after Lehman Brothers, right before Lehman Brothers, oil was at $150 a barrel. And if you remember, December 2008, oil went to $34 a barrel. So we're at this, I'm not suggesting it's going that low, but we are at a point, because I don't know where it's going, but I can certainly say with a lot more conviction after spending time with the 4 governments I was at, that they don't know any more than we do. They're concerned about their market share, and we're witnessing a true event that all the statistics were there. I mean, this is everything I just told you statistically. Everybody knew 4 months ago. And you know what triggered this is a bigger question. But the most important thing is, Andrew, this is a massive tax cut for the world. This is really good stuff for the world. Now, ultimately, lower oil prices, according to the governor of Bank of India, Raghu Rajan, he has said to us that he believes GDP in India could grow by 1% more, maybe even more because of lower oil prices since they import all this oil.
Right.
So ultimately, one would expect lower oil prices will increase GDP enough where you're going to start seeing demand, increased demand. And so where is that equilibrium? I don't know. But we're not going to really understand the equilibrium for 18 months.
Okay, but you control $4 trillion, and
Yeah.
that's with a T.
Yeah.
Most money in the entire world, I think. Is there
Yes.
Any other firm that? No. Okay.
But that's just a statistic.
It's a statistic.
Yeah.
But if you were a mom and pop investor out there, or you're somebody in this audience, or you're somebody watching this,
Right.
and you have a little bit of money in your wallet,
Right.
are you supposed to think that this is a beautiful time in the markets? Or are you supposed to think that actually everybody knows it's a beautiful time in the markets already, and therefore it's actually not that beautiful?
So a year, 2 years ago, equity prices were undervalued, just looking at PEs. It's fair to say equity prices are above fair pricing. Maybe, what are we trading, about an 18 PE? And I like 16 better than 18. But if you believe interest rates are going to remain lower longer, if you believe the Bank of Japan, the Bank of China, the ECB will be still very aggressive in stimulus, if you believe the Federal Reserve will begin its normalization of interest rates, but at a more elongated path, an 18 PE is not so bad if you believe interest rates will remain lower longer. And that is my view. And that's why, for those who are underinvested, it's time to get back into the market. But hopefully everyone learned a bitter lesson. You know, if your liability is a 40-year liability for retirement, why do you care about the world at any specific time? You need to be fully invested over a long cycle.
What about bonds?
I think, as I said to you last week, the trend for bonds remain to be lower rates. More insurance companies I know are mismatched. Their liabilities are longer than their assets, all expecting interest rates to go higher. We're all living longer. The liabilities of pension funds are extending. We had massive deleveraging in our society. And so interest rates will remain lower longer than we all expect and probably want.
We just had Paul Singer out here, and he made the comment that he thinks the Federal Reserve, which might be helping prop all of this up to some degree, has exacerbated inequality in this country. Do you agree with that?
Well, I think it's fair to say low interest rates have stimulated a huge market rally in equities, and I think it's fair to say those who own equities are wealthier people than poor people. And I would think the Federal Reserve and other central banks would agree on that. Do you have a better solution on stabilizing our economy? Does Paul Singer have a better solution in stabilizing the economy? I would suggest the Federal Reserve has done a fantastic job of stabilizing the economy. I don't know where we would be at the economy. I think we are learning that the terrors of the 2008-2009 financial crisis is still very much a part of the fabric, and I can't imagine where we would be without that stimulus. That being said, we are witnessing worldwide, because of low interest rates, more inequalities than ever. And I don't think that's a mystery. I don't think that's like a revelation. You know, if you own equities and you happen to have financial assets, you did fantastically well. Poor people are trying to save, you know, they don't even have money to save. They're trying to make sure their means are met every month. And so, we need to start focusing on wages and focusing on long-term solutions instead of things like activism and other things like that destroy jobs.
Activism destroys jobs.
I think over a cycle we see CEO behaviors, and I've talked about this on your show. We see CEOs are spending too much time focusing on share repurchases, dividend increases, which help shareholders, but in many cases, not all cases, in many cases, they should be reinvesting in jobs or capital expenditures. And I'm not trying to suggest, there's some really crummy companies out there with entrenched management, with entrenched boards, but I'm not trying to suggest some of the actions of activists are all negative. But what I witnessed, especially when I was at the Business Roundtable with you, I had many conversations with CEOs who are not targets, but they're frightened of being targets. These are very well-run companies. And are they holding back a little? Why do we have $1 trillion of cash? They're holding back, we're not reinvesting. This is one of the reasons why I believe we have an anemic society. And look, I'm not blaming it all on activists by any means. And as I said, some of them do a very fine job and some of them don't. But if you ask me, does activists harm job creation? The answer is yes. Now, I know a lot of people will throw stones at me on that, but I don't think you would.
Well, we're going to open it up to questions in just a moment. But let me ask you this: you've expressed major concerns over time about the fact that people are not investing enough for retirement.
Correct.
This has been a big issue for you. My question is, who are you more worried about? The baby boomer hitting retirement age now or very soon, or the millennials, many of whom are not saving at all?
I'm worried about both, and unfortunately, this is the biggest systemic risk to our society. And one of the reasons, by the way, it's not a big issue in Washington, federal workers don't have a retirement problem. The federal thrift plan is spectacular. It's the greatest defined contribution plan around. It does a fantastic job for federal workers. And I asked myself, why isn't this a big issue in Washington? And I have to allude that their retirement problems are not a problem like so many other people. The problem we have, people are trying to make their means met. They don't have the capacity to save. And the problem is the average American who's retiring today, I believe, have less than $25,000 savings. And they're relying on Social Security for 80% of their cash flow. This is one of the reasons why, if you look at all the labor statistics, the greatest increase in job creation are for men and women over 62, where people have no choice but to work longer. Now, that's a good thing. I would raise anyone. Why would you want to retire if longevity means that most people are going to live to 88 to 90? Why would you retire at 60 when you have a third of your life left? So I actually think it's good you're having to work, but in many cases, people don't have a choice. They must work. So that's problem one. Problem two, the millennials, as you suggested, are not saving enough. They don't understand what it takes to have enough of a nest egg to live in dignity.
And do you think that's a new phenomenon, or it's always been the case that young people haven't saved?
No, I don't think it was always the case. I mean, I think most people I know, when they were young, they were saving by then. I don't think this is I think it's becoming more acute now. Look, this is not a today problem, and so it's not a today problem. We don't address this. But we need to be focusing on mandatory retirement plans. Social Security is just one leg of a stool. Social Security is it's just an insurance plan. Keep in mind, the average American receives $18,000 a year for Social Security. And as I said earlier, that's 80% of their savings. That's a pretty awful situation that so many Americans are going to live in poverty in retirement, or they're going to have to live with their children. So when I speak at various universities, I said, I have bad news for most of you because your parents are going to be living with you, whether you like it or not. Unfortunately, I actually, and maybe we're going backwards, and I don't mean that in a negative way, backwards how society was. I mean, how society used to be before probably World War I, but definitely after World War II was family units stayed together longer, and there were generational people living together. I think we're going to go back to that, and I'm not sure that may be a good thing or a bad thing. but I don't know, many people may not have a choice.
Right. Let's open it up for a couple questions from the audience, so everyone can get a shot on goal, if you will. Are you the goal? We have a question right over here.
Hi, Larry. Mary Shapiro talked today about regulating and paying more attention to the asset management industry.
You mean Mary Jo White?
Mary Jo White.
Got the
Sorry.
wrong Mary.
It's been a long day. Can you talk? Are you concerned about what might come out of this? And can you talk a little bit about it?
I only read the highlights, so I have not read the entire transcript. But what I read, I thought it was fantastic. What Mary Jo White was actually saying was what we've been advocating. I do believe there needs to be much more transparency related to mutual funds and ETFs. I believe there should be a review of leverage within, embedded leverage within different products. And I do believe there should be some type of liquidity understanding on each product. So this is exactly what we've been calling for years, that we believe instead of naming an asset manager systemic, because I could name a lot of $2 billion hedge funds that exhibit more systemic risks than some of the things we do at BlackRock. But I have products at BlackRock, and so do some other people, that probably require much more transparency. And so we've been advocating this, and this is a great response to the evolution of how we should look at the ecosystem of capital markets and asset managers. And we should have better transparency. We should have better measurements of these type of embedded risks in products. And so we were excited in what she said today.
Is there any reason to think that you are systemically important? This has been a long, simmering question.
I know, you may think we are. I think you do think we are.
I think at $4 trillion.
But it's not my money. And more importantly, I have 20,000 types of accounts. I mean, I'm not the owner of the money. I'm responding to the contractual obligations we have as a fiduciary to all our clients. And I think another good example of the activities of that West Coast manager, it was with all the highlights and all the stuff around it, whatever the liquidations were, it was done orderly, and it proved that even big events like what happened, the markets responded well. The asset manager did a great job with their clients in terms of if a client chose to move, it was done in a very orderly way, and the market survived that in a very transparent way.
Okay, let's try to sneak in one more question, then we will. All the way in the back.
Here comes a mic.
What is most concerning to you in terms of an asset class, a product that people are over-investing in without fully understanding?
Well, I've said this in the past. We will not do ETFs that are backed by or collateralized by bank loans. We believe that the product is a great product, but there may be a moment in time where the liquidity, getting back to what Mary Jo White was talking about, where the liquidity may not be suitable for a daily valuation and minute-by-minute liquidation. So those are the types of things that may not be suitable, but if there's better disclosure, and I know there's good disclosure on those products, that's fine. We have been always against leveraged ETFs because I don't think people understand what it means. Once again, there's great disclosure on it, so I'm not trying to suggest a lack of disclosure in any of the products. But in most cases, a lot of people are, there's a lot of noise around the high yield market right now and the valuations. And I keep on telling people who tell me, the high yield market is high yield. I said, why don't you spend time talking to insurance companies who are originating new annuity products that have to put money to work, and because all the QE, they can't afford to buy a government worldwide, they have to put their money to work, or they're gonna have a bigger asset and liability gap. Or why don't you talk to a pension fund that is addressing their long-dated liabilities? They need to put their money to work to try to make sure their retirement plan works for their clients. And so when I hear specifically regulators or gadflies talking about markets, please talk about markets in the in the confines or the ecosystem of why it's there. And you understand why valuations are there is because there's unbelievable demand for high-yielding product because you can't earn the appropriate returns in treasuries anymore. And you need to be, because of regulatory issues, you need to be in bonds. You can't be in equities because the capital charges are too high. And that's why we have these valuations now. And so when you talk about valuations, you have to put it in the context of why it's there. And there's a lot of commerce going on. A lot of people are looking for annuities, and insurance companies are writing annuities. They need to invest in it. Pension funds every year are getting new funds from their participants. They have to put the money to work. The other answer is, do you want to be in cash and have a 20-year, 30-year gap? I don't think that's sensible or a good fiduciary responsibility. And so when you think about the market, put it in understand liabilities when you think about asset valuations. And I think there's too much noise about asset valuations. And there are some assets are mispriced. Obviously, oil was mispriced. But you have to put in the confines of why it's there and why are these participants buying. And so to me, it's, to answer your question, as I said, most people understand what they're buying, and they understand whether those products are liquid or not liquid, or those products have extreme valuations. I think most investors understand what they're doing, what they're investing in. The area where we need to focus on making sure disclosure, this is what Mary Jo White was talking about, disclosure in retail products are adequate to meet the needs of the investors who don't have the full resources of understanding the risk of any one product.
Larry Fink, everyone. Thank you.
Thanks, everyone. Andrew.
Thank you very, very much.